In this module, we'll compare 3 ways digital platforms can settle tokenized assets: stablecoins, tokenized deposits, and CBDCs. Each model affects liquidity, compliance, risk, and finality, and sets up the design choices behind delivery versus payment and atomic settlement. So far, you've built the asset side: market context, platform choices, and token contract design. Now we turn to the settlement question. What form of digital money completes the transaction safely, reliably, and at enterprise scale? Tokenized issuance is not just about moving the security. It also needs a dependable payment leg. A smart contract can coordinate both sides, the investor's funds and the issuer's or seller's tokenized asset. The settlement instrument, whether a stablecoin, CBDC, or tokenized deposit, determines how final, liquid, and enforceable that payment is. The goal is atomic settlement. Either both transfers complete together, or neither does, reducing counterparty risk and operational breaks. Not all digital settlement instruments carry the same risk. Start with 3 questions. Who issues it, what backs it, and what claim does the holder have? Stablecoins are private tokens, supported by fiat, assets, crypto collateral, or algorithms. Tokenized deposits remain commercial bank money, while CBDCs represent central bank money. For architects, this taxonomy shapes settlement finality, redemption rights, regulation, integration design, and suitability for institutional workflows. Fiat-backed stablecoins begin with reserves: cash, bank deposits, treasury bills, or similar low-risk assets. The issuer holds and manages those reserves, then mints tokens that users can transfer as digital money. When tokens are redeemed, the issuer burns them and returns fiat. This model works only if reserves are real, accessible, and well-governed. For regulated settlement, the key question is whether holders have a clear legal claim and dependable redemption. A stablecoin is only as strong as 2 promises: what backs it and who can redeem it. Strong reserves are liquid, low risk, and separated from issuer operating funds. But redemption rights matter just as much. Retail users, institutions, and market makers may face different eligibility rules, limits, fees, or settlement times. If redemption slows during stress, confidence can break quickly. Architects therefore test both asset quality and operational capacity. Issuance works best as a controlled life cycle. Fiat or eligible reserves arrive first, and they must be verified before any token is minted. Compliance checks run alongside that flow, including KYC, AML, sanctions screening, and wallet monitoring. Once tokens circulate for settlement, Treasury manages liquidity, bank cutoffs, intraday balances, and settlement windows. When a user redeems, the token is burned. Then fiat is paid out through the banking rails. Trust in a regulated stablecoin is built through evidence, not promises alone. Attestations provide periodic, third-party confirmation of reserve balances and token liabilities. Audits go deeper: testing controls, financial reporting, reserve management, and operating procedures. Reconciliation connects the core data: on-chain supply, pending mints and burns, reserve accounts, and treasury records. When that matching happens continuously, institutions can detect variances early and manage settlement risk before it becomes a crisis. Asset-backed stablecoins use reserves such as gold, treasuries, money market fund shares, or other securities instead of bank deposits. That can improve diversification, but it adds new questions. What is the asset worth today? How quickly can it be sold? Who holds it? And can holders legally claim value if something goes wrong? Redemption terms are critical. A token may redeem for cash, the asset itself, or an equivalent value, and each design carries different risk. Crypto-collateralized stablecoins replace bank reserves with on-chain collateral. A user locks volatile assets such as Ether or Bitcoin into a smart contract, then mints stablecoins against that value. Because the collateral can fall quickly, the system requires more collateral than the debt is worth. If the ratio drops too far, liquidation sells collateral to repay the stablecoins. The weak points are pricing and timing. Bad Oracle data or slow liquidation can break the peg. Algorithmic stablecoins try to hold a peg without fiat backing. Instead, they rely on rules that expand or contract supply, plus incentives that encourage traders to restore the price. Their main weakness is confidence. If liquidity dries up or the related token loses value, the mechanism can become reflexive. Dilution leads to selling, selling drives price collapse, and collapse triggers more exits. For regulated settlement, these designs should be treated as high risk unless controls are strong. Failures often happen when one weak layer feeds the next. If an oracle reports bad prices, collateral can be misvalued. That can trigger liquidations. But liquidations only work if markets are deep and liquidators are motivated. In a fast sell-off, forced selling can push prices lower, causing even more liquidations. Good design adds breaks. Circuit breakers, conservative collateral haircuts, stress tests, and governance controls that can respond before volatility becomes a system-wide crisis. Tokenized deposits take a familiar bank liability and make it usable in ledger-based workflows. The customer still has a claim on a regulated commercial bank, not a free-floating crypto asset. But the record can move through institutional wallets, compliance checks, treasury controls, and payment rails with more automation. The key design challenge is interoperability. Banks, ledgers, and existing settlement systems must coordinate without weakening legal certainty, risk controls, or operational accountability. Another way to compare settlement assets is by who stands behind them. Commercial bank money, including tokenized deposits, is a claim on a bank. Central bank money is a claim on the monetary authority, so it carries the strongest finality. Wholesale CBDCs extend that central bank settlement asset onto programmable infrastructure for institutions. The promise is faster, direct settlement, but adoption depends on policy choices, privacy, access rules, interoperability, and connection to existing payment rails. The key lesson is that selection matters. Fiat and asset-backed coins depend on reserves, redemption, audits, and reconciliation. Crypto and algorithmic designs add oracle, liquidation, and peg risks. Tokenized deposits and CBDCs may better fit institutional settlement. Next, we apply these choices to delivery versus payment and atomic settlement.